A few weeks ago, there was a widely watched report on 60 Minutes, and it was an interview with Michael Lewis, who recently published a book, and it claimed that the stock market is rigged. It's basically a book written by Michael Lewis, and it talks about the effects of what's called high-frequency trading on the market. Now, high-frequency trading is nothing more than computers being used to rapidly move in and out of securities, basically market timing, with nothing more than the hopes of trying to capture a fraction of a cent per trade. So high-frequency trading has been around for more than 20 years. And the entire basis of Michael Lewis's book and the 60-minute report is actually pretty silly. If you really try to understand that, folks, nowadays cars are starting to drive themselves. I can probably fly an airplane across the country or across the globe with nothing more than my iPhone. And this report says that I'm supposed to be shocked that computers are now widely used to execute trades rather than humans. Worse off, the claims that high-frequency trading cost investors a penny or more per trade is widely exaggerated at best, since if this were the case, stocks would be trading at such huge prices that it would be beyond belief. Now let's look at an example. If you purchased the Dow in 1990, which was worth at that time $2,810, and sold it in December 31st of 2013 for $16,577, which was what it closed at that time, would you really be concerned if it cost you a penny extra? Is there really a crisis here? But I would say that there isn't. However, the true impact, which I have actually seen and has actually been proven, is that high-frequency trading actually is beneficial to markets, as over time it has proven to lower what we talk about the spread, which is the transaction between the buyer and the seller. It's been proven to actually lower those prices and actually has brought more transparency in the market. So it has actually been beneficial to investors or to the retail investor. Now, mind you, no one should be surprised that every market has its flaws. There are areas in the stock market especially that are susceptible to insider trading, price rigging, false information, you get the gist, etc. Okay? It's natural, it's unavoidable, and obviously it's distasteful. But overall scheme, it's small and does not preclude anybody or anyone's ability to create personal wealth and investing in a prudently allocated, globally diversified index portfolio. High-frequency trading matters only to institutions that are trying to market time and capitalize on the movement, on the price movement of stocks. So if you're, trading a few million shares a day, then it probably has an impact to you. But however, if you're just a regular investor who's trying to retire, who's trying to stay retired, or put kids through college, then in reality, this conversation is irrelevant and is totally inconsequential. So thanks for tuning in to Financial QB TV. Make sure to get our book, which is right here on the left-hand side. And I look forward to seeing you next week.